I have spent much of my life studying the rise and fall of fortunes, the triumphs and failures of investors who came before us. And through all those years, one figure stands apart. A man whose ideas did not merely survive the chaos of markets, but thrived within it. His name was Benjamin Graham. To some, he was a scholar, a teacher, a meticulous analyst of numbers. To others, he was a philosopher of money, one who believed that investing was as much about character and discipline as it was about knowledge or skill. I first encountered Graham not through the pages of his books, though they are now revered worldwide, but through the stories of the markets he navigated. The Roaring Twenties, the devastating crash of 1929, the despair of the Great Depression. It was a time when fortunes could vanish overnight, when speculators and dreamers were crushed under the weight of their own ambition. And yet, amid all this chaos, Graham found patterns, principles, and most importantly, a way to protect what mattered most, your money. Today, we call it the principle of safety first. But in Graham's time, it was more than a principle. It was a lifeline. It was the difference between losing everything and being able to rebuild, stronger and wiser. It was the philosophy that guided him, not just in numbers on a page, but in every decision, every investment, every calculated risk. In this journey, I will guide you through Graham's world. We will explore the lessons he learned from catastrophe, the wisdom he distilled into his writings, and how these ideas remain as vital today as they were nearly a century ago. Together, we will uncover the essence of protecting your capital in every market, navigating both panic and opportunity with the calm, reflective insight that defined Graham's approach. But to understand why safety was paramount, we must first step into the markets Graham faced. A world of dizzying speculation, of fortunes made and lost in the blink of an eye. And it was there, amid the frenzy, that the seeds of his timeless principles were sown. To truly grasp Graham's obsession with safety, we must first step into the world of the 1920s, a time of dizzying optimism and unchecked speculation. The stock market was a theater of dreams. Prices soared month after month, and almost everyone believed that the good times would never end. Ordinary people, factory workers, shopkeepers, even teachers were buying shares on margin, borrowing money they did not have in the hope of instant riches. Graham watched this frenzy with a critical eye. While others were caught up in the excitement, he measured the value of companies not by the crowd's enthusiasm, but by their actual earnings, their assets, their ability to endure hard times. It was a lonely position to take, and many ridiculed him for it. Why worry about a margin of safety when the market only goes up, they said. Then came 1929. The market, inflated beyond reason, began to wobble. Panic spread like wildfire. By October, fortunes that had been built over decades evaporated in days. Graham, who had warned of the dangers of overvaluation and speculative mania, saw the destruction firsthand. He watched investors, once confident, now desperate, liquidate positions at catastrophic losses. He also watched those who had adhered to principles of safety survive relatively unscathed. The Great Depression that followed only deepened the lesson. Banks failed, businesses closed, and unemployment soared. In this crucible of economic disaster, Graham's philosophy crystallized. He realized that investing without a protective buffer was not merely risky, it was reckless. Preservation of capital, he understood, was the foundation on which any successful investment must be built.
And yet, his principle of safety was not about fear or inaction. It was about preparation, discipline, and rationality. It was about understanding that markets fluctuate, that prices can swing wildly, and that human emotion, greed and fear often drives those swings far beyond reason. What exactly did Graham mean by safety first? It sounds simple in words, almost self-evident, but in practice, it was revolutionary. He believed that the preservation of capital, the simple act of not losing your hard-earned money, was the bedrock of all investing. Without it, no potential gain could ever compensate for what was lost. Central to this idea was what Graham called the margin of safety. Imagine buying a company's stock for less than it is truly worth, so that even if the market falters or unforeseen challenges arise, your investment has a cushion to absorb the shock. It's like building a house on solid rock rather than shifting sand. If the storm comes, the house stands. If it doesn't, you still live comfortably. Graham did not offer a single formula for this. He offered a philosophy. He taught investors to scrutinize a company's earnings, its assets, its debt, and its management, and then to ask a simple question. Am I paying a price that offers a reasonable buffer against the unexpected? To illustrate, consider a company from his era, a textile manufacturer in the 1930s. Its stock, though undervalued by the market, had strong cash reserves and consistent earnings. Many investors ignored it in favor of flashy, hyped-up stocks promising overnight riches. Graham, however, recognized its intrinsic value and invested. When the market eventually corrected, those who followed Graham's principle weathered the storm without panic, while the speculative crowd suffered enormous losses. The modern lesson is clear. Today's markets may be digital, global, and fast-moving, but the principle remains unchanged. Buying undervalued assets, ensuring a cushion for error, and not chasing speculative excitement, these are the timeless rules of safety. Yet Graham knew that safety was not merely a numbers game. It was as much about human behavior as financial analysis. Investors are naturally drawn to what is popular, to what promises the fastest gains. Safety requires resisting that pull, having the discipline to stand apart, and the courage to act rationally when others are driven by emotion. One of Graham's most enduring lessons was deceptively simple. There is a world of difference between an investor and a speculator, yet so many fail to recognize it, even today. I remember reading his words and realizing how often the markets reward the bold for a moment, only to punish the reckless in the long run. In Graham's time, the line between investing and speculating was blurred by euphoria. Ordinary citizens bought stocks on margin, gambling on continual price rises without understanding the businesses behind them. Speculators chased the headlines, the rumors, the promise of instant riches. Investors, however, sought value, margin of safety, and reasoned returns over the long term. Picture a dialogue from that era. A young trader boasts about doubling his fortune in months through margin buying. Graham, ever calm, might have asked, "And what if prices fall by half tomorrow?" The trader, blinded by greed, could not answer. Graham would not have mocked him. Instead, he observed, analyzed, and quietly chose a different path. Speculation, Graham warned, is seductive because it promises quick gains, but it carries hidden dangers. One market collapse, one panic, one error in judgment, and all your capital is at risk. Investing, by contrast, is deliberate, cautious, and guided by research and rational principles. It is designed not to thrill, but to endure. The distinction is subtle, yet vital. Speculation gambles with what you cannot afford to lose. Investing protects what you must preserve. Safety is impossible without this awareness, because no amount of analysis or margin can compensate for acting like a speculator in a chaotic market.
Graham often described the market as a great pendulum, swinging between irrational exuberance and overwhelming despair. Prices rise far beyond reason when optimism dominates, and then they fall just as far when fear takes hold. To him, this was neither a puzzle nor a tragedy. It was a reality every investor must accept. I recall one story he recounted about the weeks following the 1929 crash. Investors panicked, selling everything in sight. Stocks that had seemed safe were suddenly dragged down with the tide. Graham observed calmly, analyzing companies not by their current market price, but by their underlying value, the assets, the earnings, the resilience of the business itself. Those who panicked lost everything. Those who stayed rational preserved theirs. This lesson is timeless. Modern investors face the same swings, only faster and more connected through technology. One day, a stock soars on hype. The next, it collapses on news or sentiment. Yet the principle remains: do not confuse price with value, and do not let the market's emotions dictate your own. Safety comes from patience and perspective. Graham advised his students to maintain a disciplined mindset even in the face of chaos. He encouraged writing down what a company is really worth and resisting the urge to buy or sell simply because everyone else was doing so. The market, he said, is there to serve you, not to control you. Graham understood that one size does not fit all when it comes to investing. Some people seek simplicity, stability, and the peace of mind that comes with steady returns. Others are willing to devote time and effort, to dig into financial statements, to analyze companies, and to take calculated risks for potentially greater rewards. To capture this, he distinguished between defensive and enterprising investors. The defensive investor, Graham wrote, values safety above all. They are patient, disciplined, and unwilling to gamble with their capital. Their portfolio consists of high-quality bonds, dividend-paying stocks, and investments that offer predictable returns. Their goal is not to chase market highs, but to protect themselves from market lows. Safety, for them, is built into the very structure of their investments. The enterprising investor, on the other hand, actively seeks undervalued opportunities. They are willing to put in the research, to carefully analyze companies, and to take advantage of temporary market mispricings. Yet even for the enterprising investor, Graham emphasized that safety must remain paramount. Every position must have a margin of safety, a buffer against mistakes, unforeseen events, or sudden market shifts. Without this, even the most diligent analysis can result in disaster. I often reflect on a story from Graham's writings about an enterprising investor who discovered a struggling company whose stock was deeply undervalued. Many overlooked it, believing the company was too small or unglamorous to matter, but careful study revealed solid assets and potential for recovery. Investing with a margin of safety, the enterprising investor bought, waited patiently, and ultimately benefited greatly, all while avoiding reckless risk. Modern parallels are easy to find. A defensive investor today might hold a mix of blue-chip stocks and government bonds, quietly building wealth over decades. An enterprising investor might research overlooked companies, buy during market dips, and capitalize on inefficiencies. In both cases, Graham's emphasis on safety ensures that no one is exposed to ruin, no matter their approach. Graham's career was shaped by pivotal moments, turning points that tested his principles and forced him to refine his understanding of safety and investing. The first of these came with the 1929 crash itself. He had warned of speculative excess, yet even he was not immune to the shockwaves that followed. Watching companies collapse and fortunes vanish, he realized that theory alone was insufficient. Principles had to be tested in the harshest realities of the market. It was in surviving this crisis that Graham's commitment to capital preservation was cemented.
The second turning point arrived with the publication of Security Analysis in 1934, co-authored with David Dodd. This was more than a book. It was a blueprint.
Graham meticulously outlined the methods by which investors could evaluate securities, estimate intrinsic value, and create a margin of safety. What struck me as remarkable even today is how much of it reads like a timeless manual. The lessons were drawn from history, yet designed to guide investors into an unpredictable future. Another turning point came through his work with institutional investors in corporations. Graham observed firsthand the mistakes of those entrusted with the wealth of others. He saw the dangers of overconfidence, herd mentality, and short-term thinking. These observations strengthened his insistence that protecting capital is not just an individual concern, it is a responsibility. Finally, perhaps his most personal turning point was in mentoring young investors, including a certain young man named Warren Buffett. Graham's teachings were distilled in conversations, letters, and personal guidance. He emphasized patience, rationality, and an unwavering focus on intrinsic value. Through these relationships, Graham's principles evolved from abstract concepts into living practices, proving their relevance across generations. Each of these moments shared a common theme: adversity tests principles, and only those grounded in safety endure. Graham's life reminds us that mistakes are inevitable, but ruin is optional. The lessons he learned in the crucible of market crises are as applicable today as they were nearly a century ago. Some of Graham's most powerful lessons are the ones that seem to contradict common sense. At first glance, they may feel uncomfortable or even counterintuitive, yet they are rooted in decades of experience and observation. Consider this. Sometimes the safest action is to do nothing. In a market overrun with speculation, when prices are inflated and everyone is chasing the latest hot stock, Graham advised patience. Resist the urge to buy simply because the crowd is euphoric. Wait for opportunities where the price reflects true value, where the margin of safety exists. It is a lesson in restraint, in discipline, and in courage, the courage to stand apart when everyone else rushes forward. Another surprising insight is that safety often requires action, not avoidance. One might assume that protecting capital means holding cash or avoiding risk entirely. Yet Graham demonstrated that by carefully identifying undervalued opportunities, an investor could act decisively and still maintain safety. For example, during the post-depression recovery, many stocks were undervalued because fear dominated the market. Graham encouraged enterprising investors to seize these opportunities, but always with a margin of safety. Acting with knowledge and caution, he showed, can be safer than inaction during times of extreme mispricing. These counterintuitive truths reveal a deeper layer of his philosophy. Investing is not merely about numbers, charts, or trends. It is about judgment, temperament, and understanding human behavior. The market often punishes impulsive decisions and rewards patience, rationality, and foresight. Applying Graham's principle of safety first in today's markets may seem like a challenge given the speed, complexity, and sheer variety of investment opportunities. Yet the essence remains unchanged. Preserve your capital, seek a margin of safety, and make decisions grounded in analysis rather than emotion. For the defensive investor, this might mean focusing on high-quality, dividend-paying stocks, well-rated bonds, or diversified index funds. The goal is stability and predictability. Even when markets swing wildly, the defensive investor's portfolio is designed to weather the storm. Patience is their greatest ally, and their discipline, refusing to chase fads, is their shield. For the enterprising investor, safety takes the form of meticulous research. This is the one who pores over financial statements, understands a company's competitive advantages, and identifies assets trading below intrinsic value. Here, safety is built into every position, providing a cushion against error or misfortune. It's not about avoiding risk entirely. It's about managing risk intelligently.
Modern examples abound. Consider sudden market corrections, whether in technology, real estate, or emerging sectors.
Investors who understand Graham's principles can see these moments not as panic, but as opportunities. By focusing on intrinsic value and applying a margin of safety, one can invest confidently while minimizing the likelihood of catastrophic loss. Graham's wisdom also extends beyond individual securities. Diversification, emotional discipline, and rational decision-making are equally essential. Markets are unpredictable, but a disciplined approach ensures that temporary chaos does not translate into permanent loss. Safety, in other words, is both a mindset and a strategy. Ultimately, applying these principles today is less about mimicking Graham's exact investments and more about adopting his philosophy: protect first, analyze carefully, act rationally, and remain patient. In doing so, investors gain not only the security of preserved capital, but the freedom to seize opportunities when others panic. As we come to the close of our journey through Benjamin Graham's teachings, one truth stands clear. The principle of safety first is timeless. It is not a rule limited to a single era, nor is it a rigid formula to follow blindly. It is a philosophy, a way of thinking that guides every decision, every action, and every investment. Graham taught us that protecting capital must always come before chasing profits. He showed that a margin of safety is not merely a buffer in numbers, but a shield against human error, market volatility, and the unpredictable swings of fortune. He distinguished investors from speculators, urging patience and discipline over impulsive excitement. And he reminded us, repeatedly, that the market is driven by emotion, greed, and fear, not logic, and that our response to these emotions defines our success or failure. But beyond the principles and the strategies lies a deeper lesson. Investing is as much about character as it is about analysis. Courage, patience, rationality, and discipline are the true assets that preserve wealth across generations. In every crash, every boom, and every uncertainty, Graham's wisdom offers a compass. Today, whether you are a defensive investor seeking stability or an enterprising investor seeking opportunity, the rule of safety first remains your most valuable guide. It reminds you to pause, to assess, to act deliberately, and to value preservation as much as profit. It reminds you that the greatest victories are not in chasing fleeting gains, but in surviving and thriving through every market cycle. And so, as we close this chapter, remember this: in every era, in every market, and in every investment, Graham's words echo with clarity and authority. Protect first, analyze carefully, and let patience guide your path. Those who heed this wisdom are not merely participants in the market, they are its masters, standing ready not just to survive, but to thrive.